Hello, friends. In this video, we will first see how Elliott waves can be drawn correctly and how profit can be gained from waves drawn accurately. As the video progresses, we will also look at how we can profit from different perspectives. Let's get started. Let's take a look at the example you see on the screen. We should note that an Elliott wave consists of 5 waves, with the long waves called impulse waves and the short waves called corrective waves. Many newcomers to the markets, when they see a financial asset they've randomly bought rising, start to believe that this upward movement will continue uninterrupted. However, when they witness price fluctuations downwards, they either panic and sell their financial asset or can't sell it, causing them distress and affecting their psychology. In reality, as you gain experience in the markets, you learn that it is essential for the price action in the market that the upward wave must inevitably be followed by a corrective movement. Now, let's see how to draw Elliott impulse and corrective waves correctly. This is the most sensitive and crucial detail in the strategy. As you can see on the screen, after forming the first impulse wave, for the second corrective wave to form, the price must extend from point 0 towards the first wave, intersecting between the 0.236 and 0.618 coefficients with its body or wick. A wave that rises again without touching these coefficient ranges cannot be referred to as the second wave. Having determined the lengths of the first and second waves in a metric manner, I can almost hear you asking where the third wave's length should be. Well, after applying this measurement for the third wave, the highest level within the coefficient range of 1.618 to 2.13 will be relevant. At the same time, for the fifth wave to be valid, it must make contact with the 2.13 level. The turning point of the fifth wave is not definite. This wave can climb quite high, especially if the price rises above the 2.13 level and closes with 2 consecutive strong volumes. We can consider the possibility that the fifth wave will go higher. However, as you can see in our example, the price cannot hold above the 2.13 level and reverses its direction downward. And you might be wondering why we don't use these peaks within the 1.618 to 2.13 coefficients range. Well, we are now seeing the answer. Let me explain. If we try to use the peaks formed after the point you currently see as the third wave, none of the candle bodies or wicks touch between the 0.236 and 0.618 coefficients, which are required for creating a valid fourth wave. How can we now determine the reversal of the overall trend due to the price failing to hold above the 2.13 level? Finally, we move the Fibonacci tool to the valid fourth wave and draw it towards the identified fifth wave where we've determined the reversal. Don't forget the first rule for price to make a correction and continue upwards. If the price reverses from within the range of 0.236 to 0.618 coefficients without touching the 0.236 coefficient, we can assume that the uptrend is continuing. However, as you can see here, the price touches the 0.236 coefficient. Now, opening a long position is not a good idea. Here, the volume analysis indicator also confirms an increase in volume. Now, due to our metric measurements, we can interpret the volume increase as a decrease. But please remember, in the markets, there is never a certainty of a 100% correct strategy, interpretation, or trade. Of course, entering trades by considering all the details will bring more profitable trades than losing ones. This is the only certainty. So, after making all these observations, are we not going to enter a trade? Now, since we are pursuing a short position opportunity, we draw the Fibonacci tool in reverse from the fifth wave to the first lower level, and we can see that the first retracement movement touches the 0.618 coefficient. And a voluminous engulfing candlestick pattern has formed. We can take a trade at a 1:2 risk-reward ratio from the closing level of the candlestick. With all these details correctly identified, a successful trade became inevitable. Of course, the end of the downtrend is likely not here, and short position opportunities should be capitalized on. We can see that in the ascending trend, the speed of the trend has finally slowed down, and the double top formation has emerged. Now, there is a high likelihood of seller orders within this area. The RSI indicator has also started moving downward from the 70 level. Due to its inherent structure, the RSI indicator is a leading indicator and can relatively forecast the formation of price movements in advance, but of course, expecting certainty would be incorrect. When used with additional confirmations, it can assist in a significant number of successful trades. Now, we will attempt to utilize the advantage provided by the RSI indicator. We draw a support line below the last lower level that has formed on the indicator and anticipate its breakout. It is likely to break before the price does. Yes, the support line we drew has been broken to the downside. Now, let's check if the price has simultaneously broken the same lower level. Despite the downward breakout of the RSI indicator, we can see that the price is still significantly above the support line. Traders who base their entries on the RSI breakout may place their stop-loss level above the order block for an aggressive entry. Now we can see that the price has also broken the same support to the downside. The RSI had crossed this support quite early, and the indicator is currently in the oversold range. A very favorable situation has now emerged for traders waiting for confirmation. From here, a short position can be opened. With a tremendous drop in the market, both aggressive and cautious traders have reached a significant profit level. Of course, it cannot be expected for the market to enter such a strong trend after every trade. Therefore, taking the first profit at 1.5 or 1.2 levels is a reasonable approach for every strategy. There are numerous ways to use the RSI indicator, and there is no need to rely on a single method. Now, let's look at a profit-making method by following a breakout that occurs after a divergence. Here, we can see that the price is making high peaks while the indicator remains horizontal. We can assume that the rising price is driven by manipulative buying, or this situation can also be considered as a bull trap set by market makers for small investors. To anticipate the start of a downtrend, let's once again draw a support line at the last clear lower level that has formed on the RSI indicator. The leading indicator, the RSI, has crossed below the support line, but the price is still trading above the simultaneous lower level. Traders considering an aggressive entry can base it on the RSI breakout. We can enter the trade once this candlestick closes. Let's see how the outcome will be. We achieved a fantastic profit ratio. Moreover, we used only one indicator for this strategy, but we also utilized the indicator's divergence and support levels. Friends, as you can see, we have debunked the view that indicators always give late and useless signals. Some indicators like RSI, MACD, CCI, provide significant advantages to traders by making leading actions, as long as you know how to get the necessary confirmations. If you like the training, please subscribe and don't forget to hit the like button. Until we meet again, goodbye.